So a very, very, very warm welcome to all of you lovely ladies on a Sunday evening. And I am super excited to have you here today. And thank you so much. You could have all been somewhere else, but you're here to learn, to know more about gold. And so without much ado, let's begin. The way today's session will be that we will first take a picture. And after we take a picture, we will go through a 5-minute presentation about Moolah for all those people who do not who are new and who haven't really, don't know the Moolah platform. So a very quick 5-minute presentation for all those people. And then I will introduce to all of you Sheela, who we are really excited to have on board today for the presentation. And then I shall hand over the stage to Sheela. And at the end of it, there will be Q&A. There will be a Q&A session. And in the middle, if you have any questions, you can put it on the chat and I'll see if we can, take those questions midway, or otherwise we'll take it in the end. So if that's fine, let's begin by taking a lovely picture. So if all of you can please come on camera for 2 minutes at least while we take a picture, and then let's continue from there. And with that, let's begin. If you can see my screen, then please let me know. Can you all see my screen?
Yes, yes,
we can. Superb. Thank you so much. So yes, a little bit about Moolah for Women. It's a platform for financial freedom by women and for women. And so yes, there is no more reason to fear. Moolah is a financial literacy platform with a special focus on women. And our unique approach is to make finance simple, fun, and jargon-free, and introduce the audience to the world of finance very, very gently so that they can start taking charge of their finances from a position of knowledge. Who's Moolah for? Moolah is for kids because they can learn this important life skill early in life. It's for young adults who want to begin managing their money well from the very beginning. It's for working professionals so that they are independent, who are independent but want to become confident about managing their own money. For homemakers who want to feel financially independent. For young women because they want to become financially free faster. For retired women because they want to take care of their money. And for womenpreneurs because we also you can also learn business finance with Moolah. We have a tribe of over we've impacted over 4,000 plus women, and we have a lovely tribe of over 1,000 women now who are from across the globe. The Moolah impact, Moolah, like I said, has impacted over 4,000 women from across the world, shifting their mindsets to make them feel more in charge, worthy, and deserving, empowering them to become equal stakeholders in financial decision-making, supporting them by making them a part of a community of like-minded women, and transforming them to become smarter, more confident, liberated, and perhaps even happier. As far as kids are concerned, we hold several workshops for kids and young adults. And the idea here is to increase their understanding about money, starting them early so that they can begin well, providing them with an environment so that they can ask their questions. I'm going to mute everybody once. Give me a second. And yes, empower them to become confident about managing their money. So for women, we offer the course called Finance Essentials and the Finance Advanced courses. These are designed specially for women. They're 3-month courses each, delivered over WhatsApp, which are 2 to 5 minutes read per day. There are 9 live Q&A sessions and 3 masterclasses as part of this program. There are monthly quizzes, and there is also 1 exclusive one-on-one session, which you can take as a part of each course. By the end of the course, women shed away their fears and start feeling confident about managing their money. We also do one-on-one coaching at Moolah, where you can accelerate your own journey by availing the one-on-one coaching services, where you can deep dive into topics of your interest, get clarity about your personal finances, or understand your own portfolio better. We also do workshops for target groups, like organizing a workshop for your kids, organization or community, which are tailor-made for the target audience, and any topic related to financial literacy or women empowerment, we can talk about and make tailor-made events for that. To quickly introduce myself and my partner, I'm Meeta Gupta. I'm a financial life coach, and I'm the founder of Moolah for Women. I'm an MBA with 30 years of experience. and I worked in banks and corporates, and I'm passionate about financially empowering women. My partner and dear friend, who's my co-founder, is here. Ritu, you may want to say hi to everyone. Ritu Prasad, she has 30 years.
Hi, everyone.
Superb. So she also has 30 years of experience. She's currently also an organic farmer and an angel investor, and is passionate about financially empowering women from across the globe. At Moolah, we invite speakers, guest speakers, just like we've invited Sheela today, to talk on various topics, whether it's related to finance or mindset building or business and entrepreneurship, or we also do book reviews and economic awareness, and also topics on women empowerment. We also do a lot of corporate events, like I said, which are tailor-made. These could be webinars and workshops for corporates and women-centric forums. These workshops are customized to suit the individual organizations and forums requirements. So we've done workshops for many organizations. Just yesterday, I did one for First American Insurance, which was another beautiful opportunity that I had. We also collaborate. So a lot of you who have been with Moolah would know that we also, for you to be able to take action after you learn and acquire the knowledge, we collaborate with trusted industry partners so that you can start investing, or if you want to take insurances, or you have any legal issues, you want to make wills, tax planning, financial planning, and more. And so we have been doing tie-ups from not only in India but across the world. This is what some of our tribe members have to say. I strongly recommend Moolah to anyone who wants to become financially independent. People get confident, they feel well sorted, confident, financial knowledge has soared, they feel equipped, their understanding of money has increased, structure and sensibility around money has increased. So those are some of the things which people have said. And so, yes, let's work together to create impact. If you want to join Moolah courses, or book a one-on-one session, or book a workshop for your audience, or collaborate with Moolah, you can reach us on email by emailing us at contact@moolahforwomen.com, or you can personally WhatsApp me on my WhatsApp number. So that's very quickly from me. That's our company, which is registered in Haryana. And we are available on social media under the name Moolah for Women. That website. We are also on Instagram. We are on Facebook. We are on LinkedIn. We've also got our own podcast called Moolah Talks. So yes, do reach out and check all these things. And thank you so much for listening in. And with that, without further ado, I'm going to introduce to you today our guest, Miss Sheela Kulkarni. Just one sec. Sheela, a very, very, very warm welcome to you. Really excited to have you today, and thank you so much for joining in today and for taking on this session. To briefly introduce Sheela, Sheela Kulkarni joined the World Gold Council in 2016 and is the head of market development and institutional investor relations for all gold-backed products in India. She has over 20 years of experience in financial services and public policy. Previously, Sheela has worked with Standard Chartered Bank and was responsible for public affairs for South Asia, working on policy issues affecting the bank and for building trade corridors between Asia, Africa, and the UK. In the past, Sheela has worked extensively for the British government in the Department of Trade and Industry, promoting trade and inward investment, facilitating market access for UK businesses, and fostering the economic and financial dialogue between UK and Indian governments. Her past experience also includes working with DSP Merrill Lynch and IMS Health, erstwhile a division of Dun and Bradstreet. So that's about Sheela. We are really excited, Sheela, and I hand over the stage to you, and a warm welcome.
Thank you, and thank you everyone for joining this session. I hope I am able to improve your understanding on gold as an asset class and its relevance in your portfolios. I'm going to start sharing my screen, so hopefully you should be able to see it. Do let me know if you can't. Meeta, is my screen visible?
Yes, it is.
Okay, great. Before I delve into all the aspects of gold, a little bit about who we are and what we do. The World Gold Council is a global authority on the gold market. We've been around for over 30 years. And our members actually are some of the world's leading global gold mining companies. We develop and deliver very high quality research, analytics, and a lot of our research that we produce is used by investment banks, wealth managers, private banks, and also central banks. We seek to improve the understanding of gold in portfolios across various categories. A little more in terms of what we've done in the past. We were the first organization to launch a gold-backed ETF in the US. And it's managed by us managed for us by State Street Global Advisors. We have a portal called goldhub.com, which is the largest open access site for all research on gold data and analytics. We don't charge anybody for accessing this research. It is all free. So any information and data that you may want is available on this website, goldhub.com. We've worked extensively with various governments. For example, in China, we've worked with the government to launch the Shanghai Gold Exchange. We also have a valuation framework. So people who are interested in understanding how gold can perform in various macroeconomic scenarios can input, their understanding of macroeconomics and arrive at, gold's long-term performance. We also work with the mining companies to develop, sustainable and responsible gold mining principles. Coming to gold, it is a very scarce but a large asset because the financial gold market is large. In terms of above ground stocks, we estimate that there are over 208,000 tons worth of gold available to different people across the globe. The proven underground reserves of gold that we estimate are in the range of 52,000 tons. Of the above ground stocks that are available, of the 208,000 tons, it's estimated that jewelry alone is 95,000 odd tons, or 46% of this total above ground stock. Bars and coins, including gold-backed ETFs, account for about 46,000 tons, or 22% of the above ground stocks. And central banks such as, Reserve Bank of India, the US Fed, or any other, the Bank of England, and many such central banks hold about 35,700 tons of gold. The other aspects where gold is available is technology, and this is about 31,000 odd tons. So this is how basically gold is available over the ground in bars and coins form, or in jewelry, or central bank holdings, or other forms that I just mentioned. Gold is a global market. In terms of, the demand, we track actually as a council, we actually track demand trends. And 73% of the world's demand comes from emerging markets, of which India constitutes about 22%. China constitutes about 29%. So you can see that in the emerging world, India and China account for maximum demand for gold. Developed market demand, which is say from countries like Europe, US, accounts for about 27% of the overall demand. Average net annual demand for gold globally is about 3,140 tons approximately. It accounts for about 181 billion in terms of US dollars. Of this 3,000 tons odd of demand, jewelry accounts for 37%. Technology demand is about 7%. So all our iPhones, laptops, and various other technology-backed products also have gold in it. 38% of the demand is for investment, which is bars, coins, and ETFs. And 18% of the demand is from central banks. In terms of, what drives gold demand? Why are people buying gold? And, we have been buying, as Indians especially, we have been buying gold for centuries. So what actually is the driver for gold demand? Why do people want to buy gold? And, an understanding of that is useful because that actually leads the demand supply dynamics and how the trends evolve. So in times of economic expansion, we see that gold demand generally goes up. When an economy or a country does well, people tend to buy gold. So prima facie, there are two drivers of gold demand: strategic and tactical. Strategic is the long-term, driver, and tactical obviously is a short-term driver. So when an economy does well, people tend to buy more gold, and they also tend to hold more gold. When there is risk and uncertainty, if there is geopolitical risk, if there is a war, if there's uncertainty in terms of where the economy of a country is headed, then people start buying more gold. Similarly, if interest rates change, if interest rates go up or go down, the opportunity cost of buying gold vis-a-vis other asset classes drives demand. So that is the tactical demand, because people take a call depending on, certain things that are happening in the market on a short-term basis. Also momentum, sometimes there is a price, a trend that is emerging and people think it's better to have gold than some other asset class. So these are the major, drivers of gold demand. In India, the situation can be a little different. We've seen that in terms of long-term drivers, when the income goes up by 1%, the gold demand goes up by 0.9%. But if the gold price increases by 1%, then the demand actually falls by 0.4%. Similarly, the short-term drivers include inflation. When the cost of buying everything else is so high, then the demand increases by 2.7%. In the short term, if the price goes up by 1%, demand actually falls down by 1.2%. Also, when we have a good monsoon, we've seen that 1% excess rainfall above the long-term average leads to an increase in demand by 0.1%. Typically, what happens is then the agricultural community parks, the money out of the harvest in gold. And every time, the government increases duty, then the demand actually goes down, because people try and wait to see how the price equilibrium is achieved before they make a purchase decision.
In fact, Sheela, maybe we can also, if you can just go back on this slide, yes. This is a very, very important slide for all of you to understand from our perspective, because we're learning investments and we're learning finance, gold as a strategic asset. And I don't know how many of you have read the paper recently that the government has now, increased the custom duty on gold, right? So they've kind of stopped. Maybe Sheela will be talking about it as we go along. But these are very important and very interesting factors which are driving the demand of gold. So if you, as we obviously, for people who are already in the Moolah community, that you'll understand some of these things, that how, and you'll see that how, depending on interest rates going up or prices going up, how, what is a good time for you to buy, because probably rates are down. So like they said, I like to give a little bit more emphasis on things like that, things like this, that in India, if the income goes up, people are actually investing a lot in gold, which is what it's showing, right? If the income goes up by 1%, the gold demand goes by 0.9%. That means in India, a lot of people are investing in gold. The price, even if the price falls, so for 1% increase in gold price, gold demand falls by 0.4%. So people still continue to hold gold even if the price goes down. So you have to understand that. In terms of short-term drivers, it says that the inflation. So if the inflation goes up, gold demand rises. People buy more gold if there is inflation, okay? Because they find it's a hedge for inflation. So they kind of feel secure when the markets are going up. In terms of gold prices, if the prices go up, the gold demand falls by 1.2%. So people hold on to gold, but their demand falls down if the prices go up. And of course, a good monsoon increases the gold demand. And if the lots of people like to buy gold from, get gold from Dubai and many other places. So if the custom duties go up, then of course, then the demand goes down. So these are some very, very interesting things. Thank you, Sheela. These are very, very interesting. Yes, please go ahead. Thank you.
Sure, thanks. And I'll answer any questions you may have, towards the end, because that will ensure the presentation finishes on time and we have adequate time for Q&A. I'll take you through the Indian demand because this is very interesting. Last year, India actually overtook China in terms of demand. China is the number one when it comes to overall demand. But last year, because China was still in lockdown mode, whereas India had opened up, we overtook China and we became the number one country in terms of our demand. So if you look at the demand, gold is obviously an integral part of the Indian culture, whether we buy it on festival days, auspicious days, weddings, occasions such as birthdays and so on. Our average demand has in the past few years been in the range of 700 to 800 tons. And it just shows that regardless of how the Indian society is evolving, people still continue to have faith in gold. And I'll come to that a little more in detail. But this chart is about obviously where the breakup of the demand is. So clearly jewelry continues to be about 80% of the demand, and bars and coins or gold ETF or investment demand, as we would like to call it, is about 20%. If you look at the price of gold, this is the annual average price in Indian rupees, and this is the LBMA price, the London Bullion Markets Association. You see how the price has moved up, say from 2001 onwards, and it's on an upward trajectory, right? I mean, today it's around 50, this is up to March 2023, but if you look at the price now, it's anywhere close to 58 to 61,000 rupees per 10 grams. But when it comes to investments, a lot of people still don't understand how and why gold. The common perception is that it's a tactical hedge, which means for a short term you could buy gold and see how it goes. A lot of people think it's no different from other commodities like copper or aluminum or whatever else. It's also believed that there are other ways to protect against inflation. And the underlying concern is, what does gold do to a portfolio? When you have a portfolio that has equity, debt, what is actually gold's role? And I think that is something that we are going to try and understand today. So I'll come to this slide a little later, but in any portfolio where you have equity, debt, corporate bonds, we look at gold's long-term performance compared to other asset classes. So over a 15-year period, we've done this analysis. Actually, gold does give returns. You look at people or a portfolio that has cash, some amount of government bonds, maybe some corporate bonds, equities, commodities. On an average, gold has given good returns. And if you look at diversification in a portfolio that has equities, gold is negatively correlated to equities. So every time the Sensex falls by say 2 sigma, the correlation goes up, which means that as equities fall, gold actually goes up. Gold gives you that cushion, where your portfolio is being dragged down by equities. Gold helps in ensuring that your portfolio overall returns still are maintained by providing that diversification. So the more the Sensex falls, the more negatively is gold correlated to the stock's performance.
So can I just intervene here, Sheela, for the understanding of the audience here? So for all of you who, just to give you an understanding a little bit more, if you see at times when the equity market is falling suddenly, so for all the people again who are taking decisions in terms of your investments, you have to realize that when the equity markets fall, there is a negative correlation, which means when the equity market is falling, the gold prices go up, also the interest rates go up. So this is a negative correlation. Why does gold price go up? Because people start buying gold, so the demand for gold increases, and that's why the prices start going up. So from a perspective that you'll always understand that, okay, the equity market is falling, so you have to now understand intuitively that the gold prices will over a period of time pick up because the markets are falling, and vice versa. If the market is rising, if the equity markets are rising, then the gold prices will start falling, and so will the interest rates. So this is a very beautiful dynamic relationship which is there. And of course, if you're a part of Moolah, we do talk about all these things in much more detail as we go in the advanced course.
So just one thing then, Meeta, so when markets go up, and for that, if you look at my slide in terms of what I showed earlier, whenever markets go up, it doesn't mean that gold will come down. Gold can also go up. But in a falling market scenario, gold definitely acts as a cushion to the portfolio. So that is the difference. It is negatively correlated when the markets are falling. And that is something that one needs to remember. And that's why the case for gold, in terms of why have gold in a portfolio. I'll also come to, the reason for diversification. So when we look at bonds, whether it is, corporate bonds or government bonds, we've taken here mainly the government bonds, gold is positively related. So when bonds do well, gold also does well. And we haven't seen a scenario where bonds don't do well, because in India, interest rates traditionally have been very stable. So gold is positively correlated.
Yes, so just to probably tell the audience once more on this, that gold is positively related to bonds. Okay, that means because the interest rates are governed by the bond market, right? So when the interest rates are high, the bond prices will go high, whether it's a corporate bond or it's a government bond. At the same time, even gold is positively correlated to that. And like we have talked before, that corporate bonds or government bonds and equities have a negative correlation, and the same thing happens between gold and equity. So this is a very beautiful relationship. Corporate bonds and gold go in the same direction, whereas gold and equity go in the opposite direction, especially when, like Sheela said, that when the market is equity market is falling.
The other reason why you need to have gold in your portfolio is the liquidity aspect. All of you know, right? I mean, today, look at the lowest strata of society. Gold has been part of people's lives, whether it's, your house helps, your drivers, everybody starts investing with the smallest amount of gold that they can buy. And that is because for a long time, Indians didn't have access to bank accounts. In a lot of places in India, bank branches were not available, but the jeweler was available. So people could buy gold and sell jewelry in times of distress. And why did it happen? If you are holding copper, doesn't mean you can go and buy and sell copper whenever you want. But gold, you could even sell it to your neighbor if you wanted money. So the liquidity aspect is what drives the case for gold. In terms of US dollars or government bonds or Indian equities, there's probably a case for gold, because the amount of gold that is bought and sold every day is over 10,000 billion in terms of rupees. So that itself shows that it is a very liquid market. There are buyers and sellers who are continuously available to buy and sell gold. Even when it comes to inflation, whether you have high inflation or low inflation, we've seen that gold does give you good returns. When the interest rates go down, again, we've seen that gold has performed well. We have this comparison, especially with the US consumer price inflation. But if you look at, the left-hand side of the chart, when inflation has been very high, we have seen again gold giving good returns. And in low inflation scenarios also, gold has performed well. So it's an asset which keeps supply, or it keeps up with money supply and inflation, and it can any amount of gold therefore in your portfolio is good, because your returns overall for the portfolio are actually cushioned by any risk. Coming to investing in gold, how does one invest, right? But you need to actually answer some questions. What and how much would you like to invest? How frequently do you rebalance your investment? As in, how frequently do you say, right, I have some amount of equity, some amount of debt, and I need to now change that allocation, whether it is 60 in equities, 40 in debt, or 80 in equities and 20 in debt. How much gold should I actually be having such that overall risk adjusted returns are good? Also, in terms of what and how should I have gold? Should I have it in the form of bars and coins? Should I have it through exchange traded funds? Or should I just keep something in my vault, in the form of jewelry? So these are some things that you have to answer for yourself as an investor.
Sheela, would you be going in more detail about the advantages of one over the other, and maybe if you could tell our audience what is the advantage of an ETF vis-a-vis vaulted gold or bars and coins, and just to give a perspective. Yeah,
Absolutely. So I'll cover the ETFs first, and I'm making an assumption here that people know what an exchange traded fund is, but if not,
don't make that assumption, please. So please explain to people what is ETF and how is it different from having gold physically.
Sure. So I'll just come to a chart which actually shows what an ETF is. So what is an ETF? ETF is basically a fund like your mutual fund, and it is backed by gold. It's also traded on the exchange. What does that mean? So, when you buy one ETF, it's backed by 1 unit of ETF is equivalent to 0.01 gram of gold. So you say you have, 1,000 rupees, you could straight away go and buy an ETF. Whereas for a bar or coin, you would need to buy a 1 gram coin or a 1 gram bar. And obviously, your investment would depend on the price of gold at that point in time. ETFs, on the other hand, and a bar and coin, you would need to go to a jeweler or to a bullion dealer who would actually be selling these bars and coins. ETFs, on the other hand, are like equities. You log on to your terminal where you would buy your equities online, and you can actually search for an ETF. There are about 13 listed ETFs, and you could buy these online. You could sell them online as well. A bar and coin, on the other hand, you have to go to a jeweler to buy. You also have to go back to a jeweler to sell, or to a bullion dealer to sell. And once you buy it, you have to store it in your bank vault or in a secure place in your home. ETF, on the other hand, it is like a mutual fund. So it is like a demat account. If you have, you need a demat account, and once you have that demat account, it will stay in your demat account. So, the storage aspect of an ETF is taken care of. And in terms of accessibility, there are mutual funds which give you the option to even have access offline. So for example, somebody who doesn't have a demat account, they could buy a gold savings fund. What is a gold savings fund? It actually is a fund that subscribes to gold ETFs. So if you don't have a demat account, then you easily buy a gold savings fund and you have a gold ETF exposure in your account. Also, don't forget that ETFs are regulated by SEBI. So the risk of buying something and it not turning out to be what it is very low, because every unit of gold is backed by 24 carats of physical gold. Bar on coin, on the other hand, you would rely on your jeweler, right? If you go to a good jeweler like Tanish, you have that guarantee that if they say it's a 24 carat bar or a 22 carat bar, it will be a 22 carat bar. But some jewelers may not sell you what actually it is supposed to be. So that risk remains. And again, like
Sheela,
I said,
would you also be covering SGBs, sovereign gold bonds?
so I will cover SGBs as well. Sovereign gold bonds is another option to have exposure to the price of gold. We just need to remember that it is a product where you have a sovereign guarantee, right? So it's guaranteed by the government of India, and you it's a bond, so you need to hold it for a long term period. Otherwise, you end up paying taxes, capital gains taxes, and it only gives you the exposure to the price of gold. So sovereign gold bonds is a fantastic product, because once you buy the bond, the government also gives you a 2.5% interest rate, and at maturity, whatever is the price of gold, that is the amount that will be credited to your account. So it's a good product. The only difference is that you you have to hold it to maturity. So from a liquidity perspective, there is that element that one needs to remember. Gold ETFs, on the other hand, you can buy and sell anytime online through your broker, or online through your own securities account that you may have. So you have 3-4 options when it comes to investments. Like Neeta said, you have a sovereign gold bond, you have gold ETF, you have bars and coins, and you have mutual funds which are subscribing to gold ETFs. So you can actually decide which mutual fund you want to go with and buy these products.
So we like to understand a little bit more about that gold saving fund that you talked about, right? Because I haven't heard of this one. So that's something interesting, which I'd love to know a little bit more.
So if you can see this slide, what is a gold savings fund or a multi-asset fund? These are two routes. If you don't have a demat account, but you still want to buy an ETF, then gold savings fund actually, are like a fund of fund, where each gold saving fund will also buy a gold ETF. So you have exposure to the ETF, but without the access of a demat account. And you can also have a systematic investment plan. So for example, you don't want to buy, say 100 gold ETFs in one go. You can actually start subscribing to a gold savings fund through a systematic investment plan.
So what you're saying is that, Sheela, that gold saving fund is a mutual fund, right? Which is through a mutual fund that you can go and buy gold, and those mutual funds are investing in ETFs, right?
Yes, absolutely.
So rather than you yourself going and taking, if you don't have a demat account, if you have a demat account, you can buy your own ETFs through the demat account, just like you buy shares and stocks. But if you do not have your ETF, your own demat account, then like sometimes you may not want to, you may not have a demat account, but you're still investing in a mutual fund, because you can go through your financial advisor or your brokers. Similarly, you can also go and tell your financial distributor or advisor that I want to invest in gold, and they can give you a gold mutual fund without you having a demat account, right? And that mutual fund will in turn invest in ETFs of various companies. Are these companies? Who manages these ETFs? Sheela?
They're mutual funds. All the
mutual funds, right? They are right. By these same asset management companies, they manage, right?
Absolutely. Right. You can also look at one more way to invest, which is a multi-asset fund. What does a multi-asset fund do? Is that it invests in equities. It will invest in gold, and it also invests in some fixed income route, which is maybe a corporate bond or a government bond. Multi-asset fund actually is a good way to get this exposure, because the risk of having just one asset class, just equities, just debt, or just gold, is completely mitigated because the multi-asset fund has a balance of all three, and you have a little bit of exposure to everything, so your returns are very well balanced, and the risk of one asset class is mitigated by the other asset class that is there in the fund. So again, you can have exposure to gold through a multi-asset fund also, because all of them have exposure to gold, to equities, and like I said, to a debt fund or a corporate bond, as the case may be.
So for all of you ladies, just one sec, Sheela, for all of you ladies, keep putting your questions in the chat box. I will be taking them all in the end. Okay. So that you don't forget. So keep putting your questions in the chat box. Thank you.
Sure. So I'm just going to go back and show you how ETFs work. Like I said, gold-backed ETFs have become an increasingly popular option for investors. In terms of tons of holdings under the Indian ETFs, there are about 13 Indian ETFs that you can choose from, and they together have about 38 tons of gold. And if you look at how they work, so each ETF is backed by gold. Each unit of ETF that you buy is actually backed by gold, and they track the price of gold. So if the price of gold goes up, then the price of ETF also goes up. If the price comes down slightly, then the price of ETF will also come down. And all of them are by regulations expected to have of the total assets that are available, they have to have allocation of 99.5% to gold. So they can only have about 0.5% to cash, but otherwise they all hold gold. 100% is actually gold.
So Sheela, can you convert a ETF into physical gold?
So, until April of this year, you could. Right now, the regulations are such that you need to, it's not going to be possible anymore.
Okay.
But you could take up to 1 kilo of delivery in gold. Suppose you had holdings such that the amount of gold in your ETFs came up to 1 kilo, you could actually have.
Earlier you could, but now you can't.
Cannot.
Okay. Fair.
So in terms of our ETFs liquid, yes, they are very liquid. On an average, 28 million rupees worth of ETFs are traded every day. And there are other equity backed ETFs, but obviously because this is gold and is the price of gold, then the liquidity is much higher.
So can I just intervene for all the people? Liquidity, I don't know how many of you understand what the word liquidity means. Liquidity means how easily can you convert it into cash, right? So if something is very liquid, it means that it can be converted into cash very easily. And ETFs, which is exchange traded funds, okay, gold exchange traded funds, which is a fund which is available on the on the exchange, and you can get it on through your demat account and through your trading account. These are hugely liquid. That means you can just go and on the click of a button, you can buy it, and on the click of a button, you can also sell it. So this is a paper form of gold, not a physical form of gold.
Correct. I've shown you all the options in terms of how to invest. Once one is going to, I will be always saying that there is a case for gold. It's also important to understand the risks. So in terms of valuation, sometimes what happens is you are able to value equities, the price of a stock, for example, you can value it because you have the company performance. Whereas gold, in my first slide, I said it is a global asset. It's bought and sold across countries. So, sometimes the valuation will not conform or to common valuations methodologies that you would use for other asset classes. What does this mean is, for example, you look at a company like Nestle, you say the stock price is 18,000 today, and the reason is its profit is so much, its loss is so much, and so forth. With gold, you can't use the same valuation methodology. The other risk or perceived risk is that gold does not provide a regular income. If you are investing in a bond, a fixed deposit receipt, you are going to get an interest rate. Depending on what is the prevalent interest rate, how does if it's a corporate bond, and if a company does well, the interest rates that they give you are definitely higher. With gold, there is no interest rate as such. So even if you hold a bar or a coin or an ETF, you're not going to generate interest from that, holding. And in terms of price, it's a very different asset because it behaves differently from equities and bonds. And it's not because, it has a low volatility. It can be sometimes, price wise volatile as well, because what happens is, the Federal Reserve Bank of the US decides, they want to change the interest rates. For example, we've seen this earlier this year, where the Fed actually changed interest rates. It increased interest rates for 2 consecutive quarters. So clearly, gold became a little less attractive because people said, I would rather move my money into a US bond than hold gold. But then suddenly, the Fed has stopped increasing interest rates. So people have started putting money back into gold. So you have to remember, the price volatility is very different for gold versus other asset classes. Over a medium term, sometimes gold has underperformed. We are looking at, in one of my earlier slides, I had actually shown how gold performed over 15-year time frame, 10-year time frame, and 5-year time frame. And if I will show that slide again. In that slide, we saw that over a 10-year time frame, gold didn't perform as well as equities did. So you have to remember that every investment is not without risks. See, look at this slide. If you look at gold over a 10-year time frame, you'll see that equities have done better. But over a 15-year time frame, gold has given comparable returns.
I'd like to say something here for the benefit of the audience. Yes. This is something which you can't, this is something which depends on when you are looking at this chart. Okay. Yes. So because this chart was drawn on, probably it says 31st December 2022. So it's for the period 5 years before that, or 10 years before that, or 15 years before that. Now, if the time frame changes to probably now, the situation would probably look different. So don't think that, oh, this is the trend which is always going to be that 10-year will be lesser and equity will be more. This is totally a dynamic thing. And like we say, past does not represent the future. So this is only showing you and giving you an understanding that things can change, and sometimes gold can give you better returns. Sometimes equity can give you better returns. Sometimes some other asset class can give you better returns. It's something which is very, very dynamic. And please don't go by these rules to say that, oh, okay, in 5 years, gold is giving very good returns, and in 15 years or in 10 years, it's going to give you lesser returns. Okay, so this is of the past. In the past, this is what it's done. In the future, it could be totally different.
Absolutely. Absolutely. And thanks, Meeta, for bringing this out, because, these are average trends, right? We are not going to say with certainty that this is how the future will look, because nobody has seen the future. Nobody knows what the future is going to be. But these are, the average figures that come up when we do our analysis. So in terms of portfolio impact and optimization, why should you have gold? Obviously, it's a diversifier. Typically, we have seen after a geopolitical event, whether it was the Gulf War in the 90s or the 9/11 attack or Brexit, and more recently, last year, the Russian invasion, gold does well when you have such geopolitical events. It actually, I think Meeta said this in the beginning. Gold is a safe haven asset, right? When other things are changing and there is too much uncertainty in the marketplace, gold provides diversification. Similarly,
Can I just put a perspective for people here, Sheila?
yes.
So what does it mean? So think about it when there is a war, or when there is, when there is uncertainty. Think about like a Russia-Ukraine war, or think about when there's an earthquake in, in what happened in Istanbul or some other country sometime back. What happens, or if Lebanon has gone through a problem, whenever there is a problem and the banks, suppose the banks are shut, and there is no other way to get money because, the currency is falling and things are not going good. Gold is something which you can always take and sell anywhere in the world. So it's a good asset to have some amount of gold, because if everything else fails, gold will always be some amount of gold. If you have, you can always sell and convert it into cash, and keep yourself away from dying of hunger. That's so that's why they say that gold, some amount of gold in your portfolio is a good strategy, because if everything else fails, you can always sell gold and everybody will be willing to buy gold and give you money.
Yeah, it is a quasi currency. It's a universal asset. So remember, whether you are here or in Turkey or in the US, gold is recognized by everybody. Equities, it is very country specific, right? You are in a country and that equity market is very different from an equity market in some other country. This is not the case with gold. Similarly, with fixed assets, the interest rate in your country is going to be different from the interest rate in any other country. Whereas with gold, it's a metal that doesn't change. It's universal. In times of systemic risk, what does it mean? Systemic risk is, when the markets, the financial markets are, in a turmoil. We've seen this, when the dot-com bubble happened, markets were just yo-yoing, nobody was sure whether things are going to be looking good for equities or not. 2002, when there was a recession, when there was a sovereign debt crisis, a few years ago, and again in 2018, when markets worldwide collapsed, or more recently, when COVID-19 happened, we saw what happened to equity markets. In such times, also gold does tend to do well. And we see that, in these times, gold obviously cushions your portfolio through the diversification element. So every time there have been crises of various sorts, whether it's recessions, whether it's geopolitical turmoil in some countries, gold is good to have in your portfolio. And we have seen that after a geopolitical event, actually gold price does go up. Again, we are giving you examples of Gulf War or the 9/11 crisis or the Russian invasion. We've seen that in comparison to the S&P 500, which is a benchmark for equities, gold has done well.
And probably to again give you a perspective here, why does gold do well? Because the price of gold go up. What do you mean by gold doing well? Means the price is going up. And why is the price going up? Because suddenly everybody is buying gold. Okay, when the market is down, when the equity is down, then what's happening? People are suddenly saying that, oh my God, my money, I'm going to lose money if I put it in equity. Let me buy gold. And now because more and more people are buying gold, the demand for gold goes up, and therefore the price of gold goes up. Okay. So because of more and more people buying gold during these uncertain times, the price of gold shoots up with time.
Yeah. Similarly, systemic risk, what I mentioned earlier, where you have recessionary environments or you have markets that are completely, crashing, gold becomes a asset to hold. When there is again a systemic sell-off, what does that mean? When everybody is selling every asset left, right, and center, again, gold performs very well price-wise. We've seen this in COVID itself, right? When COVID lockdowns were announced across the world, all equity markets started crashing because there was so much uncertainty. People didn't know what was happening, and they said it is better to have cash. Now, everybody doesn't want to have cash in the bank. It's good to deploy it somewhere, and we saw that people started actually buying gold, and most of this gold was in the form of ETFs, because jewelry markets were closed, there were lockdowns, you couldn't step out of your house and buy jewelry. What could you do? You could buy gold online because markets were still open. So if you had an account, whether it was a mutual fund or an ETF, you could just buy it online. So we've looked at, how much gold typically one should have, and how does gold affect your portfolio? We've looked at a portfolio where, fixed income in India, especially where people tend to have more of fixed deposits in their portfolio, say 50, this is a hypothetical portfolio again. You have 54% in fixed income, which is, your government bonds, corporate bonds, and such types of investment. 43% is in equity markets, and 3% is alternatives, some other asset classes. If you have a portfolio that is like this, over a period of 15 years, if you have added gold to this portfolio, then, depending on how much gold you add, whether you add 2.5% to this portfolio, 5% or 10% gold, the risk-adjusted returns have gone up. What does this mean? If in periods of turmoil, like I just said, whether it was, the 2008 crisis globally, or COVID crisis that happened more recently, or, you look at 2001 when the dot-com bubble happened. If you had to put gold in your portfolio, then if you account for all the risks, having gold helped the portfolio by giving you returns which were mitigating the risk as a result of having just equities, or just fixed income and equities. And
again, Sheela, if I can just intervene, just for you, just go back one sec if you can.
Sure. Yeah.
So just to explain this a little better. So the fact is that here, this is, first of all, you have to understand this is a hypothetical scenario, right? That if somebody in their portfolio has 54% fixed income assets like your bonds or government securities, and 43% of equities and 3% of other assets. So what Sheela is trying to say is that if you change this mix over a period of time and start getting more gold in your portfolio and increase your portfolio such that 10% of this mix becomes gold, they're saying that as if you keep increasing and making, adding more gold to your portfolio, your returns overall may improve. Again, not will improve, okay? May improve depending on, again, there's a lot of factors. We said that what time have you bought it, what time are you, what's whether the economy is in recession or is in boom, all those things make a difference. But over a long term, having a increasing gold in your portfolio to a little bit larger extent. I mean, nobody's saying that you should have full 100% gold, 50% gold, 40% gold, but maybe 2.5, 5, 7.5, 10, those kind of percentages of the total assets that you have. Maybe you may want to look at gold because it could give you better returns over a period of time. Now, this is all something which has been seen in the past, does not mean again it will happen in the future. But again, it's a case for gold to say that it's good to probably have a decent amount of gold in your portfolio.
Yeah.
Yes.
Like you wouldn't have 100% equities, right? Because equities are so volatile, and you would also not put everything in fixed income. You always want to balance your portfolio, and gold helps in actually giving you that balancing effect by reducing risks from these other asset classes. So we've also done an analysis of what it does to a portfolio's volatility. What is the reward to risk if you have gold, whether it's 2.5, 5 or 10% gold? And, how does it bring down the actual effects of a drawdown? What is drawdown? If your markets crash, if the assets that you are holding completely don't do well, the difference between the maximum returns that you could get versus the lowest returns that you could get, how does gold actually improve all of these factors? So in terms of returns, an average portfolio without gold, if it gives you, this is again a hypothetical example, if it gives you 8.4% return, then if you have say for example, 10% gold, the returns would go up by another 0.5%. So your portfolio would give you, instead of 8.4%, it would give you 8.9%. How does it actually improve the volatility? What is improving volatility? It basically reducing, the risk that a volatile or, a very risky portfolio can give. So average portfolio without gold, the volatility is 9.6%.
Sheela,
But-
let's not talk too much in this. It's going to get confusing for most of the people. Let me just explain this to you in a very simple thing. That if
Sure.
you think about it, that your portfolio has only equity and it has bonds, okay, and the market is like really volatile because now the 2000, like there was a 2008 crisis which happened, or COVID which happened, and because of it the market is like going up and down. You don't know whether the bond is going to go up or the equity market is going to go up. At that time, having a little bit of gold, which is a safe, like we said, gold is a safety net, right? It provides some kind of safety when everything else is going bad. At a time like that, having a little bit of gold kind of gives you a little bit of comfort because it reduces your risk. Okay. So you feel a little comforted if you have a little more gold in your portfolio, especially when the markets are very, very volatile. We won't go by these numbers because obviously this past has nothing to do with the future. But the only thing you understand is, and if one key takeaway if you want to have is that rather than having all your assets in only equity or only debt, some amount of gold can give you some comfort, especially when the markets are volatile and you're saying, oh my God, मेरे पैसे equity में भी डूब रहे हैं और लो ये भी नहीं ऊपर जा रहा और क्या करें? At least you are comfortable कि सब कुछ नहीं डूबेगा. At least gold तो है. Right? So that's all that you need to take away from this slide.
Absolutely. So we have, this is just an information. We have some tools on our website. And for those of you who want to kind of experiment and see, how gold will do well, if you add in some figures, even if they are hypothetical, these are models that we have developed in-house. And we typically show this for people who do a lot of analysis themselves in terms of how gold could perform in different scenarios. So that's more or less what I had to cover, and I'm happy to take questions now. And Meeta, I think you've probably seen the chat where people have put questions. So I'll leave it to you to filter the questions.
Yes,
and then...
yes.
Yeah.
So Aditi has asked, what's gold saving fund? Aditi, has that question been answered? I think we answered that question, right? That it's a mutual fund where you can straight away go and go to the mutual fund and take a gold saving fund, which in turn invests in ETF. How do we invest in that and what's better? We've already talked about that. Bar or ETF? Now, would you want to say anything on that, Sheela? Bar or ETF?
Yeah, so see, you can buy a bar. There's absolutely nothing wrong, except that you would have to find a place to store it. Whether it's your bank lockers or your home, you will need to find a secure place to store it. ETF, on the other hand, is a demat thing. So you can just store it in, you don't need to bring that bar home because the ETF is doing it for you. And it is in a demat form. So it's a paperless form, and you can actually...
What's the expense ratio of ETFs, gold ETFs? Are they very low or they high? How does it work?
Yeah, it's less than 0.5%. So they're quite low.
Okay. So I think to answer your question, Aditi, it really doesn't matter, whatever you're more comfortable. If you like to have gold in your hand and say, oh my God, I have it in my locker and I feel safer, then so be it. Otherwise, ETFs and gold, and having a gold bar, there is absolutely no difference in terms of possessing it.
Correct.
Usually what is the, but this is not true of sovereign gold bonds. Okay. Bonds, SGBs are very different. SGBs, like she said, Sheela said, there is two things in it. One is that you have to hold to maturity. And if the value at maturity has gone down, then you will get that price only, right?
Yeah.
Because at the time of maturity, whatever is the value of gold, irrespective of whether you bought it at a higher price or a lower price, you're going to get that price. Okay,
Correct.
so that's the difference between sovereign gold bonds and an ETF. Usually, what is the holding? Yeah.
I think also between ETF and holding a gold bar is also the minimum investment required, right?
Right, right.
Because to hold a gold bar, you need that much money, and ETF, you can gold ETF, you can just do with 1,000 rupees or whatever, and still be
Absolutely.
invested in gold. Yeah.
Absolutely. So you can have much smaller. Thank you, Ritu, for bringing that point. You can have much smaller amounts that you can invest and still have gold in your as an asset. Unlike a bar where you will have to invest some 1 gram, 2 gram, 10 gram, whatever minimum.
And
Absolutely.
also remember, you need to be guaranteed about the purity of the bar that you're buying.
Yes,
So
you're
you need
so
to be
right.
very sure where you buy it from, who you buy it from,
Right.
and that is equally important, right? Because you think you have bought a 22 karat gold bar, but actually it may not be. And I'm not saying all jewelers are like that, but you have to have a lot of faith in who you're buying it from.
Is there anything that you can check? I mean, because there are those ISI certifications and all. Do you think you would like to talk about that, Sheela, very quickly?
Sure. So see, in 2021, the government made hallmarking mandatory, but they made it mandatory for jewelry, which means that, every piece of jewelry has to have a BIS logo
Certification.
called the HUID mark. It's a unique ID on each piece of jewelry. And, jewelers cannot sell jewelry now without the HUID mark. On bars and coins, that is coming up, but not yet there. It will soon be there. So all bars and coins will also be marked. But you still have places like India Government Mint, for example, from where you can buy bars and coins, and those are of the highest purity because it's the government mint. You can actually get your purity is assured. Only thing the government mint is not accessible to everyone wherever they are, right? You need to know where it is. You need to go there, pick it up, bring it home. You have to remember that. And
So just tell us very quickly. So if you're in Bombay or in Delhi, is there a place where you can go and get it from the government mint?
India Government Mint in Bombay is right next to the RBI, and you could go and buy your bars and coins from there. And Delhi also has an office where you could buy. Kolkata also has an India Government Mint where you could go and buy. So India Government Mint. But see, remember one thing: you can buy, but they will not. You can't sell there. You can only buy. So it's a one-way thing. Whereas an ETF, when you buy, you can also sell. Because that's how the ease of buying and selling on an ETF is. And that is something one needs to remember. And like Ritu pointed out, is the quantity. In a bar and coin, you have to buy a minimum grammage.
Yeah.
Whereas in an ETF, one ETF is, 0.05 grams. So you can buy for as small a quantity as you want.
Usually, what is the holding time for these sovereign bonds, the term period till maturity? I think it's 10 years. Sheela, would you know these SGBs are, I think, minimum 10 years kind of thing, right?
8 years.
Yeah,
8 years.
8 years. Okay. Are there capital gains tax for gold ETFs? Yes, just like normal gold, just like every other asset class. Even yes, Priyanka, there will be capital gains depending on long term, short term, whatever, however number of years you've held it for. An example of multi-asset fund will be, what will be? Do you know some multi-asset fund names, Sheela?
Sure. So you have, for example, Quantum. You have HDFC. You have Nippon.
I think all AMCs, all asset management companies will have one multi-asset fund. So if you go and check on Money Control and say multi-asset fund, you'll be able to scroll down and see which are the asset management companies which are giving you multi-asset funds, and where gold is a part of that multi-asset fund. I think you can check that online. Priyanka, is gold liquidity there in multi-asset fund? No, it's a fund. The fund manager manages the fund, Priyanka. You cannot extract the gold out of a fund. Okay, just like mutual funds, and just like the way it happens in mutual funds, you cannot take one stock out and say, okay, I want the HDFC out of it, or a ICICI out of it. Similarly, you can't take a gold out of it. It's just that you put your money in that fund, and then the fund manager manages that fund. I'm sorry, Sheela, for answering some of these questions.
No problem. Please do.
Equity. What is equity? Neha, you will understand about equity as we go into Moolah. You've just begun the Moolah journey, so wait a little bit more. You will understand each of these things a little bit more in detail as we go along. So yeah, hold on to that right now. Aditi, so if we invest in gold bar, won't it have more liquidity compared to gold ETF? No. In fact, gold ETF can be sold in a minute. You go to the
Yeah.
exchange and you sell it off. Gold bar, you'll have to take it to various jewelers and start selling it off, right? And somebody will say, "Ki, "Achha, ye to pure nahi hai, iski to hum check karenge." So there are many things. Whereas in ETF, you can sell immediately.
Yeah.
Even ETFs, no interest rates? No, ETFs don't have interest rates. Only SGBs offer 2.5%. Sovereign gold bonds. ETFs do not offer interest rates. It's just like holding gold. Just like you have physical gold, which doesn't give you any interest. Similarly, ETFs don't give you interest. It's just that it's in a paper format rather than holding physical gold.
Correct.
Does the value of gold derive from global economy or Indian economy? That's Saraswati's question.
Gold is a global asset, right? And the value is derived from many factors. One is the supply. You know, if the mines stop producing or they cannot produce, then obviously there is going to be a shortage. If more central banks start buying gold, not just the Indian RBI, there are other central banks who are buying gold. So it is global economy as well. Indian economy to a certain extent because we are one of the largest buyers. But I wouldn't say it's only Indian economy, it's global economy too.
So it's a global asset. You have to remember, Saraswati, that it's a global asset because of which it's governed by the global prices. Okay, so if you see that the India prices will not be very different from the world prices, it'll be pretty much the same. Okay, so whether you buy gold in India or you buy abroad, you will
also there may be a difference, Meeta, because when we are not as a country, we don't produce any gold, right? We are importing all our gold. And how do we import? In US dollars? So depending on our exchange rate, the price could be different. If the US dollar rate is very high, then the imports become expensive. Whereas you could get gold at a cheaper price elsewhere outside India because it's not, imported in that country. But in India, we are importing it. So the price.
So I would say that the custom duty and all could get added to it, but otherwise the conversion rate should be, depending on what the conversion rate is, it'll be the same. If you convert it, you have to, whether if today the conversion rate is 80 rupees to a dollar, you'll get it at multiplied by 80, but when it becomes 83, you'll have to multiply it by 83. But otherwise it remains kind of the same. If you see converted into USD, the price will be nearly the same. When should we sell gold? Tina says, when should we sell gold? Any thoughts, Sheela?
That would depend on what you want to do with the money that you use after selling it, right? So some people will sell gold if they want to fund that money for their child's education. If they think they want to use it for, buying something else, then completely up to you. Or if you think that, okay, I had a target price in mind and I think that price has arrived now, I will sell gold. But remember, gold is a long-term asset, so although some people do buy and sell at very short intervals of time, it's completely up to you as to what you want to do with the money. Because, it's the same thing. When will you sell equities? And even if you sell equities, what will you do with the money? So it's your choice in terms of when you want to sell.
Right. So in terms of, there is no hard and fast rule, Tina, to understand when to sell anything or to buy anything. It really depends on your investment strategy and what are you looking at in terms of from that asset, right? So if you want to keep it for long term, you want to keep it for your kids, you want to keep it for whatever, then you say, no, I'm happy with keeping some gold, so be it. Otherwise, you may want to sell it because now you've you say, okay, now I've already made my money or I've lost a lot of money in gold, so I'm going to exit out of gold. Your call totally. Does ETF, do we pay GST on ETF?
No.
What are the tax factors connected with ETFs and gold savings fund, which is better when selling, like capital gains? I don't think it matters.
Yeah, it's the same, right? Because you will pay, even on your mutual funds, you will pay capital gains. And same with ETFs.
So will the mutual fund cap, I mean, this whatever is there for equity, is that capital gain taken, or is it for debt, or what is the capital
debt.
gains
So
for debt?
ETFs are treated like a debt fund. So
Okay.
you need to hold for 3 years.
Right. So gold ETFs will be treated like debt funds. So whatever is the capital gains tax on debt funds, similar will be on gold ETFs. Okay. Which is also true on gold also. So even if you buy physical gold, this is the same thing, unless you're buying it in the black market, then you don't need to pay tax.
Yeah.
Right? If you buy out of cash and you don't declare it, that's a separate story. Gold mutual fund gives us any interest? No, gold mutual funds don't give any interest. MMTC gold bars are authentic.
Yes. MMTC is a public sector company. Their bars are authentic.
So we can invest in ETFs and later can we change it to, no, we can't. That's what Reshma, that's what Sheela said, that from April this year, you cannot change it into physical gold. You can sell it and use the money to then go and buy physical gold. But earlier you could have actually traded your ETFs and actually got physical gold, but no longer. What is the minimum amount for SGBs?
So the minimum amount is the price per bond. Whatever
Sheela,
the government
we
declares
lost
as the
you in the
price
middle.
per
Sheila,
bond
we
is the
lost you.
minimum amount.
Can you
hear me now?
Yeah.
Okay, so the price or the minimum amount is one bond. You cannot buy half a bond, right? And the price of the bond is decided by the government when they announce, the launch of these bonds. So every quarter, the government comes out with an announcement and they decide the price. So the minimum amount would be one bond. And therefore, the price for that bond would be, whatever is the price at that point in time.
Right. If no GST on ETF, then it is cheaper as compared to bars. Is that true?
So again, on bars, a lot of people add making charges. And on ETFs, there is no such thing as a making charge. So you would have to decide, what is the quantity of bar that you want to buy versus the ETF and then compare the price.
So GST is not on the bar. GST is on the making of the thing. Okay. It's like when you provide a service, then you have to pay. Okay. So if there is no service, it's just an asset that you're buying, then you don't pay any GST, whether it's through a ETF or a physical gold, right? But if there is a making, because in a physical gold, they'll make something, so there'll be a GST which may be charged on that making charges. Okay. If no GST on ETF, but where is the capital gain tax when selling? Capital gain tax is different from GST. GST is when you buy it. Capital gains is when you sell an asset. Okay, capital gain is the gain that you get when you, is the difference between your buying.
No, I understand that.
Yeah.
I understand what capital gains and what GST is, but like my question was that if there is no GST at the time of purchasing an ETF or gold ETF, but then at the time of selling it, there is capital gains, right?
Yeah.
Yeah. So so that's what. So if it's like a physical gold bar and I go sell it, they're not going to charge me capital gains on that if the price of the bar goes up.
No. So capital gains is something you declare.
Yeah, you have to declare.
You have to declare capital gains that I bought it at that and I'm selling it at that. If you don't declare it, then you don't. Then I mean, that's what I
So
said. That
an
in case
ETF
of a capital gain, if you're doing a physical, if you're actually buying gold and you're not declaring it that I bought it and I sold it, if it's physical gold, you don't have to pay capital gains tax. But in case of an ETF, because it's in a demat form, there will be somewhere which is shown. So probably you'll have to declare it for sure. So to that extent,
maybe in that sense, gold physical is better because then you don't have to declare the capital gains if you sell it later.
Sure.
I don't know. Just thinking.
Sure. I mean, those are some things which are gray. We don't talk about it.
Yeah. Unofficial,
Okay.
so you will not be able to comment on it.
Yes. So any other questions from any of you? So maybe if you can stop sharing your screen, Sheela, that'll be nice. So any thoughts? How was today's session? I know some of you are new to Moolah and some terms like bonds, equity and all are all going over your head. And that's absolutely fine because that's where we are at Moolah. Understand whatever you've understood. Otherwise, you can always revisit it, and we will be talking a lot more about gold as we continue to be in the Moolah, go through the Moolah journey. So don't feel disheartened that you didn't understand parts of it, which is absolutely fine. Okay, so just take it with a pinch of salt. Jitna samajh aaya, good. Nahi aaya, forget it. Okay, I'm always there to
Sorry,
teach you as we go along.
Hi, Meeta, Stora here. Just wanted a quick question that as Indian women, like my mother and everybody, not everyone has gold bars or coins, but we have jewelry. Then what do you do about it? Then, like, is it then how if I were to sell it, then I get the price of just the gold, even if it has diamonds or stones in it, right? Which is separated out of a jewelry set or anything. Just a question.
Which is true. If especially, I mean, I've done that myself, so I'll probably answer that, Sheela. That if you have very small diamonds, they'll really kind of say कि हम लोग ये नहीं निकाल सकते, हम खाली आपको gold का price देंगे, और वो भी they'll be when you thinking it's 18 karat gold, but when you go and sell it and they put it in the caratometer, it will come to 14 karat gold. So you'll probably land up making much, getting much lesser than you even thought that you would. And of course, making charges and all those things kind of really take away the price of what you paid, and what you get is probably a lot of difference between what you think you'll get and what you actually get. So sometimes, unless you're really fond of gold as a jewelry, probably as an investment is not one of the best investments to hold jewelry in terms of an asset class.
Thank you.
Sheela, yes, any thoughts from you?
Decide what you're buying. Yeah, I mean, in terms of your decision, you have to decide what you want to buy it for. Are you buying it for adornment? Do you want to be seen with the jewelry? Then please, of course, buy jewelry. But if you're buying it from an investment perspective, then you have to decide whether you want a bar or coin, or an ETF or a sovereign gold bond. You have these options. To wear jewelry, to have an occasion coming up, you have a wedding in the family, then jewelry, of course, makes sense. Because you want to be seen with that jewelry. You can't tell people I have ETF at home. But
I love that. My gold is in ETF form.
But like
that's why I'm not wearing any of it.
No, but like Meeta said, when you go to sell your jewelry, you don't know what you have bought, right? It was bought at a time when hallmark was not mandatory. Plus, they will deduct making charges. You go to any jeweler, they will say, we will deduct making charges from the final price. So you will end up getting less. And plus, if it's studded, even, you have it studded with, American diamonds or real diamonds, they will deduct all of that and give it to you.
Absolutely. Any thought on gold coins from banks? Would that be a good alternate than jewelry? I mean, again, any thoughts?
2013, RBI stopped banks from selling gold coins. Whatever gold coins were being sold till 2013, they were all Swiss made coins, very good coins. But think about it, you want to sell the coins, you can't go back to the bank. The bank is not authorized to buy back your coin. And right now they are not even available for purchase. So bank as a mode to buy and sell is not available right now.
What are the making charges on bars and coins?
Again, it depends from whom you're buying. It varies, but it is lower than the making charges for jewelry are much higher than for bars and coins, but it differs from jeweler to jeweler.
No, but what if I were to go to the RBI mint and buy it from there?
You can buy it from there, but they will not. You can't sell it to them.
No. But
what are the making charges?
Again, it would be specific. You'll have to check at a given point in time how much they are charging, because sometimes for higher denominations, the making charges is different. For smaller denomination, the making charges are different. So you would have to go there and check.
So that's something which is their domain. We won't know it, Priyanka. Yeah, so they may even change it with time. So none of us would know that.
Yes.
Sorry, I have one last question.
Yes, sure.
Just about because not with me, but like with my mom also, because as Indian women, we buy jewelry more than we buy bars or coins just generally. Can you tell us a little more about insuring our jewelry or gold? Because I mean, there must be a method, right? Like, in terms of collectively insuring your jewelry? If there's
Everything you can
anything like
insure.
that.
Flora, you can insure anything. Okay, if you go to an insurance
Okay.
company and say you want to insure your gold jewelry, they'll give you a price for it, and you can, I mean, in case you lose it, then you can obviously go
Yeah.
to the insurance company and take it. In ETFs, you don't need an insurance, right? Because it's not in physical
Yeah.
form.
Yeah.
Whereas if you have a real, then you can, like you insure your home, you insure your car, you can also insure your jewelry.
Okay.
And in fact, with ETFs, what happens is the fund house has already insured the gold that they have bought. So that is taken care of.
Okay. Okay.
And plus,
Okay.
it's not lying in a physical form in your house. So it's like very convenient, right? It's all online. Your fund house
Yeah.
is regulated by SEBI. So God forbid anything goes wrong, you have SEBI and investor protection fund to take care of everything for you.
So you won't lose the asset, right?
Yeah.
I think
Right.
that was
Thank you.
super awesome. I hope you all got something out of today's session. Maybe if anybody wants to unmute themselves and say what were the key takeaways for any of you, just for us to understand what was something that you took away from today's session. Flora, yes, please. Yes, please.
Yeah, just wanted to say thank you to Sheela for coming and giving us our time to explain about gold. Because like growing up, you understand gold in terms of jewelry and you understand, oh, it's a good investment, but didn't understand till now why. And thank you so much for coming today and explaining that to us. And the key takeaway was that, the understanding of gold as a hedge in like the worst times. It's like an apocalypse comes and then you still have gold, as Nita had told us before. Yeah, that was my key takeaway, that there's a very grave importance given to something which is so permanent, in that sense that like irrespective of your investments, that you can monitor, and they might have changes in terms of interest rates and everything, but gold will always be there for you. So that was one of my key takeaways. Thank you.
I think that was super awesome.
One thing that I did mention is that gold is the only asset or only commodity in the world that is recycled. See, all other assets, whether it's silver, you all know silver gets oxidized, right? So if you buy 10 grams of silver, when you try and recycle it, there is always going to be less amount of silver in whatever it is that you bought, whether it's a bar, a coin, or a jewelry. Whereas with gold, if it says it's the net content of gold and it is 10 grams, you can recover 10 grams. So it gets recycled. All
Gold
our
does not
iPhones
tarnish.
have gold.
Gold does not tarnish. Okay,
Yeah.
gold does not tarnish as compared to any other metal. Copper, silver, all of them tarnish. What does it mean? That tarnishing means that it gets oxidized and its value gets reduced.
Right.
Whereas gold does not get oxidized. Okay, so it remains in that same form. There is, even after 100 years, if you take out gold, you will get the same amount of gold. It won't become lesser. Whereas the silver or anything might become lesser because it will get oxidized, and because of which it gets tarnished. So that's the beauty of gold. Thank you, Sheela. That was really, yes, another very interesting and very pertinent thing which everybody should know. So I think that was a super awesome session. And thank you, Sheela. Thank you. That was really a nice session. I really enjoyed it, and I'm sure all of our audience did. And thank you so much for your time. And thank you, all of you lovely ladies, for being here on a Sunday evening. And let's keep empowering ourselves and let's keep rocking. Thank you so much and have a good Sunday evening. Bye.
Thank you for having me.
Thank you,
Thanks.
Mita. Thank you, Sheela. Thank you so much. Thank you, Mita. Thank you, Sheela.
Bye.